Interesting fact about self-storage is that there's actually more self-storage in the United States than all the Starbucks, McDonald's, and Burger Kings combined. In fact, there's 60,000 facilities nationwide, and there's actually, if you combine all fast food chains, there's still more self-storage. I was actually out in Coeur d'Alene not too long ago, and I started picking up on this, that there's a lot of self-storages in this town, and there's more self-storage than there are places to go dine and eat. And in fact, 1 in every 10 Americans uses a self-storage. So show of hands, who's used one or currently using one? Okay, a little bit above the average in the room. And 66% of people that use self-storage also have a garage. And as we know, there's about 330 million Americans in the United States. So that's about 33 million people that have a self-storage. And that means one thing: we have scale. We can scale this to 555 customers on average per facility. And that means customers that we don't have to provide toilets or leasing agents or appliances in every unit or water heaters. We don't have any eviction moratoriums or eviction notices that we have to go through. And our units don't look like that when the tenant moves out. Just a square wall, square box, sweep it out, move on. But I think what's most interesting about self-storage is that it's not because Americans have too much stuff. Show of hands again. Of the hands that were up, put it back up if it's because you have too much stuff. A lot less hands, a lot fewer hands, right? Well, I thought self-storage was pretty silly myself until I had a family and I had to move and sell my old smaller house and buy a bigger one. And I bought the bigger one, and then we wanted to renovate it and expand it. And guess what I did? I used self-storage. And as Americans, we have the convenience of self-storage all over town, but I argue that it's not because we have too much stuff. And I want to tell a little story. I was in the airport right when COVID hit, and there was a 737, 180 passengers or so can fit on that, and there was one passenger on the plane, and I just had to ask the person, "Where are you going?" Well, my mother just passed away. I'm flying to Florida so I can put her stuff in self-storage. Self-storage is dependent on one thing only, and that is life events. Life events, age, relocation, downsizing, upsizing, moving, relocation, friction in the economy, or disruption in the economy is what creates self-storage events. And if you look at the occupancy trends of self-storage against the declines in GDP over the last 30 years, what do you see? Well, what I see is Black Monday, when the markets cratered over 30%, 1987, we saw self-storage occupancy remain steady. When we saw the dot-com bust of 2000, self-storage occupancy remained steady. When we saw the Great Recession of 2008, 2009, self-storage remained steady. And in fact, most recently in COVID, when GDP went way down initially, self-storage went on an absolute tear. Occupancy spiking, rents increasing 12.7% year over year during COVID. And when you look at all the other REIT data, you can see that self-storage REITs, while they were hit about 10% initially, all REITs were subject to speculation, self-storage was over 80% performance. And when you compare it against all the other real estate REITs, it was the highest performing asset class during the pandemic. Now, when you look at 2010 to 2020, who feels like self-storage is being built all over the place? Right? It is. It's being built everywhere. And from 2010 to 2020, there was more self-storage built during that time frame than all the self-storages that had been previously built prior. Saturated market. But look what happened to the average occupancy of self-storage. It grew 10% during that time. So not only did they add so much inventory, it was absorbed and national occupancies only increased. Everybody remembers the eviction moratoriums of the pandemic. As Americans, we wanted to protect people in their homes, in their living, in their dwellings. We had rent freezes, we had eviction moratoriums. We wanted to make sure that people weren't put out on the street. That makes a lot of sense. Self-storage, however, let's face it, nobody cares about grandma's dresser, right? We didn't have these things that stopped self-storage from raising rents or having our self-storage auctions, etc. In fact, self-storage during the pandemic caught the eye of a lot of sophisticated money. Specifically, during the last 18 months, Public Storage has picked up $3.3 billion worth. Blackstone jumped into the game and bought their operating platform, Simply Self-Storage, for $1.2 billion. Then we had Bill Gates jump in and buy a quarter share of StoreMart. We had other operators like Inland Capital monetizing. We had CubeSmart coming out, Simply Storage picking up another 10,000 units. And it went on and on and on. And eventually, the Wall Street Journal picked it up that this is the hot property of the pandemic because people wanted to put their money in a safe place. That same year, we went on to acquire about $270 million. This was picked up in the journal. Last year, we picked up about $270 million. This was a $200 million post here. But what's the one thing that makes us different than all those other operators is that we're approachable. You can pick up the phone. You can talk to our team, you can get questions answered, etc. And we have the benefits of limited partner investing where you get depreciation and all the benefits of actually participating in the limited partnership interest of a self-storage investment. So a little bit about us, Spartan Investment Group. Our headquarters, we're in Golden, Colorado. We also have a small satellite office in Seattle. And today, we're the fourth fastest privately held real estate company, fourth fastest growing as ranked by Inc. magazine, 126th fastest growing company overall. We've been on the Inc. list for the last 3 years. And we operate everything under our Free Up Storage national brand. So we do all the direct management of our properties. And a couple of years ago, we decided to flag it under one brand management, which is Free Up Storage, so that there was a differentiation between Spartan and then and our operating company, Free Up Storage. We vertically integrate everything, so we own everything from the acquisition, the capital markets, the construction, the debt. We syndicate all of our capital from retail investors, and then we do all the asset and property management. And we have about 114 employees at our company today. These are the markets that we invest in: Sun Belt, Pacific Northwest, Colorado, and key markets in the Midwest where there's high population growth. So we look for generally 2%, 1 to 2% annual population growth where we're going. We want to go where the population goes. And the best part about self-storage is it doesn't matter if you're in a blue state or a red state. Does not matter. We go where it makes sense because we don't have the local landlord laws that other asset classes have that restrict them from their business plans. So a little bit about where we started. This is our first Spartan project. This was in our nation's capital, right in Washington, D.C. This is at 13th and Pennsylvania Avenue Southeast. And I was previously I have a career in aviation and was an airline pilot. That's me and my daughter in the cockpit of an Alaska Airlines 737. I was about to fly her on her first flight, and we took the family to Maui. Well, we lived on this street in DC, and the house to the right of the middle house was up for sale. And I really, really, really wanted this house to sell. So every single time somebody walked by, I would go outside and pretend to check my mail. And the 14th time that day, and my wife was about to kill me, this guy walked down the street. His name is Scott Lewis. He served in Iraqi freedom. He's an Army vet. And struck up a conversation and convinced him to buy the house 2 doors down, and he convinced me that we should start Spartan Investment Group. So I thought that was a pretty good deal. So our first project was actually right in between the walls of our own house. It was a rundown, vacant house, as you can see, and we fixed it up and sold it. And we really wanted to create something special. We wanted something where we could enhance the lives of our employees both personally and professionally. And that's in our vision statement. And resulting in providing high-quality investment opportunities for our investors. And we had a mission, vision, values mindset. And our values are defined by our GRITT: growth, respect, integrity, tenacity, and transparency. And this is what we live and breathe day in and day out. Every employee that goes through our rigorous hiring process, we want to make sure that they possess the values of a Spartan. They're expected to know these, and they're expected to have examples of how they fit our values, our core values at Spartan. So we put everything through a due diligence process. As an airline pilot, if you make a mistake, people tend to get injured, or worst case scenario, they could die. As an Army vet, Scott makes bad decisions on the military field. People could get really hurt or die. So we basically took a rigorous due diligence process to everything that we do. We have a 700-point due diligence checklist that we share with our investors. On every single deal, we put the same process through a very checklist-driven approach. The other thing that we like is communication. We like to communicate. We communicate every single month to our investors on the 1st. And we share pictures if there's a construction element of the property. We share a narrative as to what happened, a description of the financials. We also share the monthly financials. So every month, we provide a trailing 12 of the P&L. We upload that onto your investor dashboard. And then we do monthly distributions. And who loves K1s coming in September every year, or August? We put that we will give you your K1s in March every single year. So we put that in the operating agreement because we know it annoys the heck out of people. I like to extend, but there are some folks or some investors that want to have their tax returns done. So we send all of our K1s in March. A little bit about us still. We have about 25,000 units. I think that number is closer to 30,000 now. Over 100 full-time employees. We've raised over $200 million of equity to date. And there's about 500 million assets under management, mostly storage. We've made the VET 100 list now the last 3 years in the EEC 500. And typical investments. So last year, we would buy stuff like this. On the top, we're one of the largest operators in Tyler, Texas. That's on the left there, that's our property on South Broadway Street. Nice Class A facility. A contractor built the property. We took it over and implemented revenue management, started cash flowing that property right away for our investors. The top 2 there are in Madison and Heartland, Wisconsin. Again, great markets, high growth, Class A properties. And then the bottom 2 pictures there, we actually built that project just outside of Seattle. So we both build and buy. Down below, these are some of our value add assets where we buy kind of the single story Class B, C vintage properties. But we're going to go ahead and walk through a video of kind of our typical project. So this is single story property, mom and pop owned, that we'll buy. And it came with about 735 units, about 80,000 square feet, existing cash flow in place. And it has some interior units, some exterior units. So it has both the climate and non-climate controlled. Sometimes these properties comes with weird things like car washes. So we will subdivide and sell these as quickly as possible. And then also we have U-Haul truck rentals on site where we can get that ancillary income. But what we like most about this deal is it came with this 2 acres here, which we built those buildings on. So about 240 units, or about 40,000 square feet. That's our construction team out there on the time-lapse camera building the units. We built both climate and non-climate units. Basically, whatever unit mix makes sense to complement what exists. And one thing that's really great about it is those units filled up very quickly. You can see that's some of the interior and exterior units that we built. And we make good relationships with local Chamber of Commerce, so that really drives marketing and awareness to the property. We do some deep grassroots marketing in every market that we go into. That's kind of our typical property. Mom and pop owner, the guy built it over the last 30 years, never raised rents, never enforced auctions, and was really good opportunity. We like good locations, scale, economies of scale. So you can see these properties are clustered in a given market, and that helps us reduce our expenses and increase our revenue by having efficiencies in a market. We don't want to have one property here, one property there, one property there. We like to cluster them together. That allows us to hire area managers, district managers, regional managers to help be efficient with payroll and also be efficient with our expenses and our advertising, where you can blanket a market with SEO and advertising. That results in better returns for our investors. Our exit strategy, kind of funny. I like to think of myself as like a medium-sized fish. And we're going out there and we're aggregating mom and pops. We're buying mom and pop operations where they have a very low basis in the property, and we can increase revenue and NOI very quickly. And those are the mom and pops that we buy from. Now, someday we have options, a lot of options on our exit strategy. Specifically, those groups, 39 people that are bigger than us, a lot bigger, some of them, that can gobble up our portfolios. Merritt Hill Capital, Blackstone, U-Haul, Public, Extra, Life Storage, etc. All narrowing in and want to buy our portfolio. You get a better cap rate when they can place bigger amounts of money into the space. So that's one option for our exit. Here, there's a lot of people that want to get into self-storage. So we can also be the bigger fish, and a lot of mom and pops that want to exchange 1031 funds, want to buy their first facility. We're going through 2 sales right now. One's a mom and pop, one's a bigger buyer. So we like to have these options for our exit. What's interesting about this too is we also will refinance and return money to our investors. They still own in the property. Or we'll get an institutional equity partner to do an equity recap in a deal. There's so many different ways to slice and dice when you get scale in self-storage this large. So 2 ways to invest with us. We have an equity fund, and that is kind of wrapping up. We'll get into that in a second. And we also have private debt opportunities for our investments. These are our 2 investor opportunities that are on the Verivest site. And the fund targets about 4 to 6% cash flow in year 1, and then it grows as we grow NOI. The fund has done 3 distributions, 5%, 4%, 4% the last 3 months. And then overall, our multiple over time to basically double your money in 5 years, typical investment. These are the assets in the fund. You can see we have 6 already in place. If an investor came in today, they'd get it at cost. Key markets like Louisville, where the property has 8 times population growth around it, and also like Chattanooga in Tennessee, where we also have 3 other properties already in that market, so economies of scale. And then we buy these properties way below market rents. This is a little bit of highlights of the fund. We've raised about 90% of the cash for the fund, 4 to 6%, assets already done, bonus depreciation if you invest. There's bonus depreciation for 2022, about 30% per invested. And you get a cost basis based on the original purchase price of these investments, since they all happened within the last few months. These are some of the facilities in the fund. This is kind of the crown jewel here. This survived Hurricane Ian very well, and now we're getting about 90 new units rented every month. It's fantastic. Disruption, right? We're providing that service. We've already got fixed rate debt on these assets and really strong demographics in that market. Another asset that's in the fund, Havelock Court, North Carolina. This is a cash flow monster. So owners have owned this since the 90s. They haven't raised the rent since the 90s. So we bought this with the rents 40% below the market, and the market is full. So if you raise the rents to market, there's nowhere to go. So we've already increased rents up 75% since buying this in June. 3 Louisville assets that are in the fund. Again, great interest rate. There's literally no competition at the Shelbyville property. and really great economies of scale having these 3 properties within that. Chattanooga, you can see the big pin. We own 3 in the immediate local area, a couple of more across the border of Georgia. Again, great interest rate on that. So kind of overall, really nice assets in the fund. No dogs in the fund at all currently. So private debt opportunity, just really quick. We pay our investors 2 points upon funding and 7% per annum interest. We do monthly distributions. It's a 9-month note, so if you're kind of wondering, quick inflation hedge or your cash is on the sidelines, it's a great short-term investment opportunity. And we have an extension option that pays 1% to extend 16 months, making it a, in total, 15-month investment at the max. So this is our website. You can jump on our distribution. We do a lot of education, a lot of publications in self-storage magazines, but also to our investors. And I've got a little time for questions. Ed and I are both here at the Verivest Summit.